Hi, good afternoon, everyone. We'll start in a few seconds. Just some housekeeping items. This webinar is being recorded, and also we'll be able to email you the respective presentation in case if you have to step out, answer a phone call, just to touch base and as a small recap as to where you missed out on the presentation to enhance your business needs as well. If you have any questions, by all means, I strongly encourage you to put in the Q&A on portal. As at the end of the presentation, I'll be moderating the questions for Mr. Ricardo to answer them for you. Also, there's going to be a poll that will be appearing in terms of get to know more about your business, how we can continue assisting your business needs, and at the same time, how can we assist you any way we can. A brief description of what is the Florida SBDC at FIU. We're your local small business assistance center in terms of if you're looking for access to capital, marketing, government contracting, we're your local SBDC that can assist you. If your business is located in Miami-Dade, Monroe County, we'll be more than happy to assist you on with our consultants. If not, I'll be able to connect you with your local SBDC center. So here's a brief description of the SBDC, and without further ado, allow me to introduce you to Ricardo Weisz.
Okay, good morning or good afternoon, everyone. My name is Ricardo Weisz. Thank you for coming to my webinar. So I'm originally from Venezuela. I moved to Miami about 27 years ago. I live here with my family, and my passion is scuba diving. And lo and behold, South Florida, especially in the Keys, is one of the greatest scuba destinations in the world. And I was here for a number of years before I realized that. So if you like scuba diving, take advantage of where you are located. I've had a long career, and I've worked with a number of wonderful organizations. About maybe 18 years ago, I decided that I wanted to become an entrepreneur. And in the last years, I've focused on either starting and operating businesses or in being an investor in startups. So that gives me a good sense of the struggles that we founders go through when we have a need to raise funds. And I also have a good perspective of what investors look like when, or what they look at when they're trying to make their decision on making an investment. So my presentation is just that: what makes a company investable by equity investors. And also I'm going to take a few minutes and also discuss what is it that it needed to make it happen. So I'm going to talk a little bit about what the investor looks like, what their expectations are, what do you need in order to pitch investors, and I'm also going to review a few slides of a sample deck so you have a good sense. The first thing that comes to mind is taking a moment to think of how do you look at yourself and the business that you're trying to create. And basically, there's two routes that you can take. You can either build a business that you want to create a legacy around that and focus on generating enough revenue and profits from the business to allow the business to sustain your lifestyle, or your business is creating businesses, and in that second version, you're really focused on growing the business as much as you can, and with the objective of selling the business within a number of years. The one important differentiator is that when you're building a legacy business, your financing is focused on traditional sources like banking, whereas when you're creating an entrepreneurial venture, the source of funding is mostly from investments. Understanding that difference is key to your process, because that overarching goal will drive the strategy that you need to create. So when you're talking about traditional banking funding, it's non-dilutive. So it means that you maintain the ownership in the company, and you don't have to dilute yourself. And you may have access to bank loans, SBA loans, or maybe even grants from the government. Whereas when you're seeking funding from an investor, you're diluting your company and sharing ownership with somebody else. So understanding that if you're going to look for funding from an investor, your interest and the interest of the investors have to be aligned. And what that means is that the windfall that you create has to be shared with an investor, and the investor typically is looking for a return on their capital within 5 years. So that means that for an entrepreneur, when they take investor dollars, exiting the business within those 5 years becomes the overarching strategy for the business. During this presentation, when I use the term investor, I'm referring to the investor that invests professionally or semi-professionally, and that it's accredited according to SEC rules. So if it's just a friend that decides to invest in your company, that may be an investor, but that's not the investor that I'm referring to. So just bear in mind that the element that I'm going to be describing really refer to that professional investor. And one thing that you may not be aware of is that if you are taking money from an investor, whether it's a friend or a professional investor, it's your responsibility to make sure that they are accredited according to these SEC rules. So what are the type of investors? So we mentioned briefly your family and friends. Family usually has no option but to invest. But we also talking about angel investors. And even though people use the term commonly as anyone that invests in the company in the early stage of the company is an angel investor, it has become more of a formal term nowadays. And a lot of professional investors fall under this category of angel investors. It's just that they like investing in the very early stages of the company. You have the family offices. These are professionally run offices of hyper wealthy individuals. And we are in South Florida is a home to a large number of these family offices. So that's an important source of funding for startups. And typically there is the outlook of their investment is somewhat different from what a venture capital firm would look at. So we mentioned family offices. We talked just now about venture capital VCs. There's also what is called corporate VCs, which are funds established by large established companies, and they have created an investment arm. And the difference between the VC and the corporate VC is that the VC tends to have non-passionate focused on return, whereas a corporate VC also pursues a strategic interest. So for example, if you're pursuing funding from JetBlue, and their VC arm, the interest of that corporate VC is to fund companies in aviation arena. And lastly, you have private equity, which is companies that invest on companies that have reached critical mass and achieve large positions in the marketplace, and they're continuing to grow. So one of the first tasks that you have to do when you're seeking an investor is understanding that investor. The fact that they are sitting on money to invest doesn't mean that they would be interested in your venture. So you have to understand what the source of their funding is. For example, a lot of these VCs and even angel investors invest on behalf of other people. So they on their own side had to create their prospectus saying this is my investment criteria and this is my investment thesis. And it doesn't matter how great the investment opportunity is, if it doesn't meet those the criteria in the thesis, they're not allowed to invest in your venture. So there has to be a match between the investor and what they invest in, and your endeavor for which you're trying to raise funding. The other consideration is that funds created by VCs are not unlimited in terms of money or in terms of time. So you hear a lot the term, the fund is closed. That means that they're not making any new investments. So understanding if what's in a historical situation of the fund is important, and whether they're making or have made recent investments as well. So when a fund is looking into an investment, the first thing that they look at is that they got to make sure that the endeavor meets their investment criteria. So they look at different factors to make sure that, or different data to make sure that it meets their criteria, and that includes a management team, what the product is, what market is being addressed, how scalable, and also understanding of what the exit strategy for that business is. They also take into consideration the industry vertical, the geography, and so forth. The thesis as compared to criteria really has to do with what their theory is. So they either invest in certain stages of development of the company, or companies that have certain intellectual property, or even their funds that only invest on companies that have already obtained SBIR or STTR grants, which are grants from the government. So understanding what the investment thesis is also important. Because you don't want to spin their wheels, and you don't want to spin your own wheels, pursuing things that are not bound to happen. So when a fund receives a business plan, and you have to, I guess people don't sometimes realize this, but a VC group may receive anywhere up to 100 business plans or more per month. So it is the way they screen those business plans is that they put those plans through a business analyst that looks at the plan and ranks or grades the plan against their investment criteria. So the more points that you get, the better the chances are of passing to the next round. So it's also important to understand, and I give another webinar on developing these business plans, is that typically the decision of whether the plan meets the criteria or not is done in very short spurts. So if I'm looking at 60 plans that are sitting on my virtual desktop, I don't have time to spend 10 minutes with each. So I'm within 1 minute or less, I'm going to determine whether it meets the criteria or not. So the information that you provide upfront is very important. So they don't toss your plan into the virtual garbage bin. How the investors typically take equity positions on the companies that they invest in. Sometimes they will accept convertible debt. Nowadays, the most common vehicle for investment is a safe, which is a hybrid between stock purchase and a convertible debt, which is really an equity instrument that allows to set the evaluation for a later date. And in past year and a half, SPACs have also been popularized in the media, and that's happening as well. For an entrepreneur that is trying to grow their company, the 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 cycle of funding really never stops. So when you decide to go this route, understand that it's a full-time commitment. It's going to take a lot of hours every week of your time, and it's going to continue and nonstop, because investors do not give you funding for the lifetime of your project. They give you funding just to get you to the next level. So whenever you're facing a new stage of development in your company, you're gonna have to raise additional rounds of funding. Um, the statistics are impressive. About 600,000 companies get started every given year. Of those, maybe 1,200 get funded at the VC level, and the number of companies that are typically go through an IPO are normally in between 100 to 150 on the average, maybe 200. Last year was an exception, and 951 companies IPO'd. So, what are the stages of a startup? Um, when you're in ideation period, it's really the first step, and this is when you create your business plan and your minimum viable product, which is really prototype of what is it that you're trying to do. Usually for that stage, the average capital need is maybe 25 to $50,000, and that comes mostly from family and friends. There used to be a time where when accelerator programs, if they accepted you, they would provide that initial funding. That's rare in today's world. Once you been able to develop that business plan and minimum viable product, the next step is to go and test out your concept, and you do that with a proof of concept. And that stage is typically more costly. It can run anywhere from 75,000 to $250,000, and this is where a significant number of companies fail to obtain that funding, and we call it the death valley, just because so many of these companies get stuck at this level. Some just disappear, some continue to make the rounds trying to get some funding, uh, but it's hard to get to the next level from this stage. So once you have that proof of concept and you've shown that you have traction and an interest in your product, the next stage is really getting that initial funding that will continue to either create a bigger sample of or your product, or you may even be able to get enough funding to do that initial commercial launch that you need. And then the next round is really when you go to the VCs and the corporate VCs, which is the growth stage. You've shown that there's a demand for your product. You're showing that your product works, and now you need money to take the product to cash flow positive situation by generating enough sales. There's about 2,700 VCs in the United States. There's about 3,000 family offices. And so it's a major endeavor trying to target this VC funds and family offices. But the startups that I've seen that have done this in a consistent way and effort generally eventually succeed in getting some funding. So at the beginning of the presentation, I spoke about what the need to align your interest with the interest of the investor, and that means really exiting your business in a reasonable time. The expectation normally is 5 years. So what are the exit drivers? Well, we talked about an initial public offering, an IPO, but if you figure that there's 600,000 companies that get started in a year, and only anywhere up to 900 IPO, the chances of succeeding in achieving an IPO are considered non-existent and out of consideration when an investor is making an analysis of an opportunity. The other exit drivers are technology, and that means that you develop hardware or software that is unique, it's patented, it's protected, and there's barriers of difficulty for any competitor to reach your level. It took me a number of years and a number of efforts or failed efforts to realize that the meaning of a protected technology as an exit driver means it's rare that you can do that with software. It has to be a really unique software that doesn't exist anywhere else. Most of the situations are just adaptations of software that exist. And the reason knowing this from the get-go is important because it allows you to make investment decisions. It doesn't, for example, it doesn't make any sense in developing a platform which you can aggregate from an open source, or you can adapt from some software that already exists. The biggest driver generally is traction, and which is achieving users for your product. It doesn't necessarily mean that that you have to make tons of money. It just means that a lot of people are using your product. Revenue, cash flow is also an exit driver, but it's usually applied to a more established, larger companies in growth stage. And the final exit driver is a situation where you have a team that has done a major development, and the team might have failed in that development, but they're a great team and they work well, and their knowledge is of interest to an acquirer. So they buy the company not because of any reason, but just because of the team that is in place. So where do you start? Basically, you have to have documents, which means, and I'll go into that a little bit better, deeper, but it just means the documents that you need in order to be able to pitch to the investors. You have to register and collocate your documents in some of the larger, more established platforms that are designed really to share documents and their depository of documents, and you use that to share your documents with your investors. And you start contacting the local angel groups, and there's angel groups in every major city that I know of. You would start attending startup conferences and start pitching accelerators. So let me take you to the next step of my presentation, which is, what are the expectations of an investor? And I'm focusing here on the early stage investor. So like I said before, they are interested in taking an equity position in your company. They're not interested in receiving dividends. They're not interested in having you buy out their share of the company. What drives them is the opportunity to sell the company successfully after 5 years and sharing the windfall with you. The rule of thumb is that in the early stage companies, the typical investor would try to seek to get 1/3 of the company for their investment. They want 20 times return. That means for every dollar that they are investing, they want to see the opportunity or the projection that shows that they can get $20 back. This is very important because if you're creating a financial projection and the numbers don't address this element, you're not going to get that interest from the investor. They expect to get their money back in 5 years or less. And if you do that mathematical progression and assuming that you never have to raise any single dollar more in the future, if you're trying to raise $1 million today under that mathematical equation, it would mean that the company would have to sell for $60 million in 5 years. So if your financial projections don't match these numbers, you're already going to have some difficulty in getting the interest of the investor. The investor knows that it's impossible that every company can achieve these results, and that's why it's a very risky investment for them. But if they don't see that potential, then they may not have any interest in investing at all. For your guidance, the typical investor is more focused on investing in software or medical devices than they would be in e-commerce or hardware or even construction. They're investors that are non-traditional investors or that investing in real estate and construction, but that's a totally different animal, and that's not what I'm addressing in my presentation. So what do you need in order to pitch to these investors? You need documents, and what that means is you have to have financial projections and they have to be detailed. Doesn't mean that you're gonna start by emailing a potential investor and say, here is my financial projections. But if the numbers don't work out for you, and don't forget you're an investor yourself, then it's not gonna work for that potential investor either. So you have to start creating that financial projection yourself. Then you have to create an investor deck. You may need to create also a pitch deck, and I'll describe the difference between one and the other. But some companies or some founders have been successful in combining both investor deck and the pitch deck, but it's not always the case. And then finally, you need an executive summary. I put them in this order because this is the order where you should be, in which you should be preparing your documents. The executive summary is usually a one pager, and a lot of entrepreneurs start by doing the executive summary. But when you do that, you don't benefit from all the thinking that went into creating the other documents. And unfortunately, the executive summary has to be the strongest of all. So I would start with the financials and work my way down to the executive summary. So what's the difference between an investor deck and a business plan? So the traditional business plan, or the business plan that you would present to a bank, is typically 5 to 60 pages. It's it's done in Word, and it's portrait form, and it has a lot and lots of information that only a financial analyst that it's paid by bank would have the time and the interest in reading through. The investor deck, on the other hand, is information that is summarized. The investor believes the process with an investor is he's not going to make a decision on the basis of the deck. The deck only serves the purpose of initiating a conversation. So it's typically 20 to 25 slides. It's a PowerPoint presentation, and it's focused around the main areas of interest that the investor may have. So what's the difference between a pitch deck and an investor deck? Well, the investor deck is a standalone document, and the pitch deck is designed for you to walk through or present. So the pitch deck is a summarized version of the investor deck. And sometimes, like I said, entrepreneurs have been able to condense the information needed in the investor deck down to a pitch deck size, and that's fine. But if you have tons of information that you need to share, then don't do a pitch deck that is 20 size or more, because the chances are you're not going to be able to walk through it. So the objective of the deck, like I said, was to initiate conversations with a potential investor. And this is what's the basis of what the conversation is, but it should address the concerns that an investor has initially, and address and allow the investor to make that decision whether it meets their investment criteria or not. So a lot of people think that an investor deck should be built like a marketing deck, but it is not. It needs to address, and it doesn't necessarily have to be in this specific order, but it does have to cover these specific areas of that the investor needs to make sure that are addressed in their deck. So what is the investor thinking when they're looking at a business proposal? Well, they want to know whether they're going to make money or not. They're going to try to think whether they're users or buyers for your product or idea. Is it going to scale? And in my experience, the biggest decision factor is who is the team that can build this company. Is the team strong, and is it coachable? So a lot of people underestimate the importance of a team. So like I said before, the process of trying to obtain funding, it's a commitment. It may take 20 to 40 hours per week. You need to make 50 or more pitches before you get any traction with investors, and it takes anywhere from 3 months up to a year to actually receive the money that you need for your endeavor. A lot of people wait until the last moment and think that they can get funded within a couple of weeks. And in my experience, that doesn't happen. So let me walk you through a sample deck. I'll explain. I'll try to explain what makes this deck strong. So this is the initial slide of the deck. So this, analyst is going to get this deck, and by using of the airplane on the graphic, he knows or she knows that it's an aviation industry item. So they can put a check mark whether that meets your criteria or not. The second aspect is that in one sentence it tells what it does or what it is, and also the added icons of the clients that they already had when they were seeking this funding. So they showing traction. So the first thing that the investor is looking is, hey, this company's got traction. It's in the aviation industry. Let me go forward. The next item is that they have a really strong team. Every member of their team comes from the aviation industry and has a deep industry expertise that weighs a lot with investors. They described what the problem is, the pain point with the industry in a very succinct way, and everyone in the aviation, that has anything to do with the aviation industry immediately gets what it is. They have a huge addressable market, and in their special circumstance, one of the great advantages of being in that industry is that every single plane that is flying is accounted for, so they know exactly what plane it is and where is it located and what airline owns it and in what part of the world and that client is. Their solution is patented. So they've created a solution that, number one, is patented. So it checks the need for an item that is protected. But the other aspect of protection is that any product that is sold into the aviation industry requires FAA certification. And apart from being a very costly aspect, it's a difficult process. So the fact that they've been able to that, it's a double whammy in terms of protection for their product. They have been able to achieve significant milestones, which is basically traction, and that makes them very attractive to a potential investor. They, by the way, have been able to obtain, and this deck is not updated, and they have 2 grants, one from the Department of Defense and another one from the National Science Foundation. Their financial summary makes sense in order to be able to achieve the multiples that the investors are looking for, with a hockey growth and a clean NOI. Their funding requirements are well explained and make sense in regards to their funding needs. And so those are just a few slides. I just wanted to share how it looks when you have a successful deck. They've been able to raise, like I said before, grants, but they also been able to close their round, and they exceeded their expectations. But it took them almost a year to get funded, and I think they made about 60 or 70 pitches to get there. Even though they, in my point of view, they had all the elements that would make them successful. So what are the takeaways? Business plan is about telling the story of your company. So the better you tell that story, the better your chances are. So you have to have a compelling story, and you have to tell that story well, and so your audience gets it. I cannot underestimate the need to have a really strong team. Um, just because you identify an opportunity doesn't mean that the investor is going to trust your ability to execute that concept. So, again, just to stress this point, investors look at the people behind the company more than they look at the concept behind the company or the idea. So it's not that much about the idea. It's great that you come up with an original idea. It's really about your ability to execute. You have to have strong financials. If the financials don't speak the story, then you're in trouble. So take the time to develop the financials. A lot of people, a lot of founders are so passionate about their concept or idea that they don't take the time to figure out how to make money with that idea. So take the time. It's really important. And this one comes from the School of Hard Knocks. Everyone has a great plan until they get punched in the face. So thank you so much for being with me today, and let me know if there is any questions.
Thank you, Ricardo. Yeah, so if you have any questions, please put in the Q&A, and I'll be more than happy to ask on your behalf. In addition, once again, the webinar is being recorded, and I'll be able to email you the respected link via YouTube, and also along with the presentation as well. In addition, my colleague Victoria will be sending out the poll as the feedback. How was your experience? Did you was it beneficial? And along with how we can continue assisting you with your small business needs as well. I have also input the link as well. So in case if you're interested to register, we'll be able to connect you with the appropriate consultants. Ricardo, I have a question. What do you call angels?
Why do they call angels, or what do I call angels?
What do you call angels?
I call angels investors that are either professional or semi-professional investors that like investing in companies that are at a very early stage of development. That interest comes from two aspects. Number one, those investors like the interaction with the funders, but also typically the capital requirements are smaller than later stage companies. So typically angel investors nowadays, they invest their own money, but they band together in clubs or associations that invest on behalf of the whole group.
Perfect. And I don't have any additional questions. Does anyone else have any questions? Don't be shy. Ricardo's
there are questions in the chat.
Yes, I have one. Where do you find the information on the investors? For example, where would I find an investor's thesis, the historical investments, etc.?
Typically, they publish that on their website, and they do that under a section called portfolio. So you look at past investments and the current investments.
And do angel investors exist for nonprofits?
No, I'm not familiar with any that, they may invest, as part of their investment thesis on investments that are good for the community, or investments in companies that have a vision to give back to the community in somehow, but the ones that are just invest in nonprofits, I'm not familiar with any.
Okay. And how come it is going from 1 million to 60 million in 5 years?
It's rare. That's why the typically an investor invests in anywhere from 1 to 20 companies before they have a chance of achieving those returns. So that's why the investor looks for high returns, because their chances of being successful are low.
How do you suggest creating a strong team?
So you have to have at least a member that. So let me phrase this correctly. The typical founding team either has 2 or 3 members, and typically the founding team, one of the members is the one that has knowledge or understanding of the technology. One of them is really an expert on the market and getting that product to market. To me, a strong team requires having industry expertise. So if you're gonna address selling to insurance companies, having someone in your team that has done in the past and knows how that is done is key. So the fact that you see an opportunity in creating a platform that allows you to see what the insurance rates are doesn't mean that you're going to be successful in raising funds unless you have someone that knows how to sell that and get that information correctly from the appropriate sources.
I don't see any additional questions. Yeah, so that's pretty much it. Like, does anyone have any additional questions or for today? Because if not, what we could do is I will be able to send you my email. So if there's another part of the slide or from the video recording that you want to elaborate more, just shoot me an email. I'll be more than happy to connect you with Ricardo or how to assist you in terms of having your company to be invested in. And at the same time, we have specialized business consultants that can assist you with your small business needs. And all of our services is confidential and no cost to you. So like I said, we're family and we're here to assist you with any way we can. So thank you for attending today's webinar, and I'll be looking forward to seeing you at the next webinar. Thank you and have a wonderful day. Take care.
Thank you. Thank you for attending.